This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's an important day. Today was supposed to be a market holiday. Of course, it's now tomorrow. Global cues are looking good. Market momentum picked up yesterday. And once again, I think market players are waiting to see if the market has got enough strength to take out new all-time highs. I'm Prashant. With me, my colleagues Rima and Nigel. Morning, guys.
Hi, good morning. Promises to be an exciting day, right? If the SGX Nifty is suggesting a 50-point bump up, we're going to get pretty close to our all-time high levels.
Yeah. I mean, last time we got to within 1 point, right? So, I think...
And finally, I can say I'm getting the Friday feeling, right? Because tomorrow is going to be a holiday.
Unless they do something again, right? Which is unlikely. I'm just joking. I mean, let us quickly tell you what you need to know as we begin another trading session. As I said, I mean, momentum picked up. And this is the point that we were making in the morning yesterday. A defensive 20-day moving average, and then what the market does. I mean, does momentum pick up? The way the sort of price action pans out, is it slow, lethargic, or, I mean, do we see some momentum in the market, basically? That will determine whether there is enough sort of in the tank to take the market higher, even higher, in a faster way. So we defended the 20-day moving average, exactly the 20-day moving average, by the way, twice, especially last week. And then now, yesterday, we climbed above the 61.8% retracement of the pullback, the recent pullback, the short 2 or 3 day pullback that we saw. So that puts us in a pretty comfortable place with bulls in control. You got global cues, which are very supportive overnight. And, a lot of people were saying that the semiconductor index is the one which will break down first, because that's where a lot of the rally year to date has happened within the NASDAQ. That went up almost 4% last night. So, NASDAQ itself was up 1.6%. The S&P was up about 1.15%. That's a broader index. So U.S. markets, once again, have re-accelerated, if anything, after showing signs of dithering, pretty much like what we've seen here in India as well. So very strong U.S. data. 3 data points out of the U.S. all beat expectations. This is, high-frequency economic data, durable goods, which beat expectations, housing, which beat expectations, and consumer confidence, which beat expectations as well. So the U.S. economy, as this data suggests, as we heard from a Fed chair at the time of the Fed decision, at the time of the pause as well, remains, in a very good shape. That means that perhaps rates are a little higher to go. We'll get to that in a bit. There are views which are changing as well at the margin. Those who were expecting a pause for the next couple of meetings are now saying that maybe one more hike, maybe 2 more hikes, just like what the Fed indicated. Now, oil prices are down to $72 a barrel. That's great news for lots of companies. I mean, airline companies like Indigo did quite well yesterday. Watch this for more. And of course, just to put everything into levels as we start the session here, the Nifty is eyeing all-time highs. That level is 18,888. We got to within 1 point of it, as I said earlier. Beyond the all-time high, once we cross that, the next target is the upper end of the channel, the rising channel, which stands at 19,190. Just putting it out there. Let this all-time high first come, and then we'll talk about what happens beyond that. On the way down, I mean, I think the 20-day very naturally is the support level, which one needs to be cognizant of, which is at 18,681. Strong defense of it for the last 2 or 3 sessions now. The Nifty Bank, by the way, which had broken below the 20-day moving average yesterday, climbed above it. And that's the reason why I'm saying that maybe banks are also starting to resume a bit of an uptrend. They've got this tailwind now. For the Nifty Bank, the level which we were watching was the 40-day exponential moving average, which is basically going to be the support. That stands at 43,541. So that's not been broken, and I think that a defense of that will continue to sort of make people look for upsides on the Bank Nifty as well. But it's very positive that the 20-day has been regained on the Nifty Bank. For the Nifty Bank, on the upside, the all-time high stands at 44,500, 44,499 to be precise, and that's naturally the target which one will eye out for. Tomorrow is a market holiday, but generally the sentiment is pretty upbeat. There are views coming in which are advising caution, moderation at the margin. But momentum is a is a very different beast out there. And right now, it seems to be coming back in the market like what we saw yesterday. SGX is indicating about a 45, 50-odd point higher start. Rima.
On Friday, you also have the quarter end and half year end, and typically globally at least, there is a lot of rebalancing which takes place. And next week, it's going to be a truncated week for the United States because they've got that Independence Day holiday as well. But back to our own markets, the much needed thrust came in from the HDFC twins. And look at the delivery volumes yesterday. Both of them, HDFC Bank and HDFC Limited, saw delivery volumes of nearly 1,500 crore rupees. Today is the June series expiry. In terms of flows, the DII outflow netted the inflow from FIs, roughly 2,000 crore both ways. And an important cue for today, there is a SEBI board made. It's scheduled in the evening, but will there be a change, any relief in the total expense ratio? That's something the mutual fund industry will be watching very, very closely. But it's the HDFC twins, right?
Well, that's right. You know, Rima, when we were growing up, every time you struggled with something, mom kept saying, right, good things take time. So maybe this good thing that we're waiting for the all-time highs, well, it's taken a little bit of time, but I guess today is the day out there. But let's not talk too much about that. Let's focus on the markets. Yesterday, the markets were looking for a trigger, and the bulls have been looking for some kind of a trigger. And that was provided because there is a hint that, in fact, yes, the HDFC merger is pretty much on. And we'll have just one entity in the next couple of weeks or so. And that's what led the Nifty as well as the Nifty Financial Services Index higher. And as we know, yesterday was a weekly expiry that played out for the Nifty Financial Services Index, which has HDFC Limited as a big weight in there. The ingredients are in place for a super end to the June 2023 series today. You had a solid close in the US markets. Crude is a little bit lower. And you have dollar index as well that's a little bit softer. You have a close yesterday from the Nifty above that 18,800 odd mark. That gives you a bullish bias to kickstart trade today. And the India VIX, well, it ended at its lowest levels we have seen all the way since December 2019. So maybe getting a little bit complacent, but in the near term, well, that's a very, very bullish indicator as well. What do the FIs do? Well, it doesn't get more bullish than this from the FIs. Yes, we're missing their shots, in the system, but now they've gone full hog. On the final day of a series, they buy more than 40,000 long contracts. That's in a ratio of 7 longs for one short position. And there was a lot of buying in the Nifty Bank futures as well. So that's telling you that the Nifty Bank could lead from here on. Even on the stock futures, the FIs added big long positions while they covered some shorts on the stock futures as well. Very, very bullish signals coming in from the FIs as well. And call writers, they have got taken to the cleaners yesterday. And I think there could be some more in store even today. The Nifty call writers, well, big unwinding being seen out there. The Nifty Bank call writers as well, that as well should come up for you. They're looking at defending higher levels, 44,000, 44,100 odd, but they got caught on the wrong side. So you have to stay long in this market. If you get stopped out, so that is the case. But in the near term, you need to stay long. For the Nifty, well, you look at the 20 DMA as the near-term support zone, and we have seen it bounce out those levels. So that's the reference point on the downside. And for the Nifty Bank, it broke out yesterday after 14 sessions of being in a bit of a consolidation phase. Yesterday, you had the highest close in the last 14 sessions. The 20 and the 50 DMA, well, they'll be support zones on the downside. SGX 50 suggesting a gap up. I think we build on from here, and the scenario is set. We could have a finale and a very, very good expiry that will play out. Let's see whether or not that does happen. But the ingredients are in place for a blockbuster expiry date.
Well, that is absolutely the case, and we'll watch that closely. Well, before we go any further, let's quickly tell you what's lined up in the first half hour of the show. We get you updates from markets across the globe. We have Foo Keen Yap of Standard Chartered Bank who will join us to discuss the global trade setup. Our research team gets you the top 10 stocks for the day. And we quickly do a fundamental stock check with Deepan Mehta of Elixir Equities, who will join us at 8:30 this morning.
On the equities, Alexander Redman of CLSA says India underperformed the APAC regional equities by 25% from October of 22 end to end of March this year, before clawing half of the lost ground in Q2 of 2023. They are now less concerned about half of the 10 reasons cited for the 40% underweight stance in CLSA's November 2022 report. However, they still remain cautious for now, given the exceedingly rich valuations, margin erosion depleting India's relative profitability, consensus EPS growth expectations remaining too optimistic, the RBI likely lagging EM central banks in timing and scale of policy easing, and CLSA's econometric model signaling the market is 14% overbought.
Okay, we've got another opinion. This is coming in. This is a global opinion again. Ellen Zentner of Morgan Stanley, who's the chief economist, says that the bar for a July hike out of the US Fed is significantly lower than they had initially expected and have now added a 25 basis point hike to their policy path. The revision is a level shift upward to 5.375% Fed funds by 2023 end and 4.375 by FY24 end. Morgan Stanley continues to see a soft landing, staving off rate cuts to next year.
Let's get some money market views then. We've got Indranil Sen Gupta of CLSA reiterating their call for rupee appreciation to 80 against the dollar by March 2024. He says this should be driven by weakening US dollar after the Fed pauses at 5.5%. Second, he adds the current account deficit should also come off to 1.5% of GDP in FY24 versus the just released 2% for FY23 as oil prices come off. Finally, he says adequate forex reserves of $600 billion plus should reduce the RBI's urgency to recoup the forex reserves. Indranil says the balance of payments estimate suggests that it should be able to avoid selling forex in FY24 in contrast to the sale of $65 billion plus in FY23.
On bonds, Neeraj Gambhir of Axis Bank says the 10-year benchmark bond traded in the range of between 7.05 to 7.1%. Hawkish central banks kept pressure on rates, with Bank of England and Norway raising benchmark rates by 50 basis points. Data, however, remain weak, with Eurozone PMIs coming softer, bringing the yields lower again. Neeraj says going forward, market will continue to watch auction demand and system liquidity is expected to trade in a narrow range. He expects the 10-year benchmark bond yield to trade in the 7 to 7.1% range for the rest of the week.
Well, we'll be eyeing all-time highs, but we have a lot of stock-specific action that we're tracking for you, and we'll get to that in just a wee bit from now in our special Top 10 segment. For the time being, we run you through the list. HDFC, HDFC Bank, HDFC Life, Sapphire Foods, Orchid Pharma, well, and the list goes on. Titagar Real Systems, you have Gland Pharma, Ramco Cements, as well as TCNS Clothing and BSC.
Okay, well, we have Phuc Hein Yap, the senior investment strategist at Standard Chartered Bank, joining us right now to take some questions. Phuc, thanks very much. Good to have you with us here. The momentum seems to be coming back into the market here after a few sideways, lethargic kind of trading sessions. So new highs on the Nifty eyed again. Do you think there is enough in the tank for the market to add on meaningful gains from here, or you think it'll tire out? New highs perhaps, but then things are looking not so certain. What's the sense?
Yeah, look, I mean, we just published our global market outlook where we actually pushed out our view of a US recession. We used to think that it would happen in Q4 of this year, but the data has been stronger than expected. So we now think that it's likely to happen in Q1 of next year. I think the US data, especially the consumers, actually has been stronger than expected. There's been delivering a better economic print than we expected. So we are kind of neutral on the global equities front. As you say, in the short term, there are a lot of indications. The S&P technically it's moved higher since it went through about the 4,200. We saw that the CFTC positioning was very, very bearish at extreme negatives. But a lot of the short covering has been done in the last few weeks, along with the S&P pushing through to 4,200. So we kind of take a neutral view now for global equities. We're neutral on the US as well, given that we do think that the US recession, while it is still likely, there are still indications that it will happen. We think the timing has actually been pushed out now from Q4 of this year into Q1 of next year. And our view really remains to be that in Asia, we think that is where the risk reward is better. That's where our preference is in terms of the further gains that is to come. So that would be including China and India as well.
So in Asia, which is where you believe the risk reward is far more attractive and is a fertile hunting ground, which would be the preferred markets? Japan has been doing well. Some of the sheen of China has come off late. India looks interesting over the long term, but rich valuations keep investors a bit wary. How would you play the Asian markets from here?
Well, we're actually saying to allocate broadly. We do not have a pecking order at this point of time, so we do like these markets equally within Asia. So that includes China, India, as well as Japan. So but we would prefer to allocate broadly. There are a lot of reasons for each market that we do like it. And yeah, the preference in China and the concern has always been the geopolitical risk, but we think we can see some of that unwinding. But there's also policies announced about the semiconductor restrictions now, whether that's going to tighten any further. We'll see how that play out. But we saw some of the visits from your senior government leaders from the US into China. So we think that is helping to abate some of the geopolitical risk. I mean, India is very, very strong in terms of the domestic growth. We like the domestic focused industries and sectors within there. We think that's going to continue to drive India's market. And within Japan, I think what's most exciting is the potential improvement in the corporate governance led by initiatives from the Tokyo Stock Exchange, prompting the companies to improve their corporate governance. And we've seen share buybacks at record highs. Net foreign inflows have also been coming in very, very strongly consecutively for more than 10 weeks. So we think that is a sign for Japan's market to potentially re-rate in terms of its valuation. But yeah, to answer your question, I mean, we are trying to advocate clients to diversify and to allocate broadly.
Hi, Fook. Good morning. Nigel on this side. You know, Fook, the last time you joined us, you were telling us that you were expecting the Fed to maybe hike once more. And then towards the end of this year, we're expecting some rate cuts. Do you hold on to that view? Because the economic data that coming out of the United States is baffling on the consumption side, on the new home sales as well. Where is the recession? You know, and you'll have pushed that back. So what are you expecting in terms of Fed action from here on? Is the rate cut still on the cards towards the end of this year?
Yeah, thanks for picking that up. Our view now in terms of how we published in our Global Market Outlook last Friday is that we do expect a pause to the upper bound at 5.25% until the end of the year. I mean, July is going to be very live. We still have an inflation print coming up next month on the 17th before the FOMC meeting. So I think July is very live, but our expectation is that we're going to see inflation coming off in terms of the trend, and that we expect a pause in terms of the Fed rate hike at 5.25% at the upper bound at the end of the year. We do see a cut happening towards the middle of next year. That's in line with our view that we could see a U.S. recession coming in the Q1 of next year. So we do see a cut happening by the middle of next year, 2024, bringing the rate down to 4.5%. And look, I mean, the signs, we started the year thinking that, you know, U.S. recession would happen. We've seen your indications in terms of your manufacturing data, the consumer sentiment. We saw the bond yield inversion that's been historically a very strong predictor. But what's been holding up, I think, has been the U.S. consumers. The spending has just been stronger than expected in terms of the pent-up savings from the pandemic. Various estimates out there could be still about $1 trillion. So that's been really holding up the economy. And therefore, we think our view of a recession has been delayed from Q4 this year until Q1 of next year.
All right, Fook, it's good speaking with you as always. Thanks very much for joining us. And we look forward to our next chat. Thanks indeed. Well, we'll take a quick commercial break here. A list of top stocks to watch is lined up when we come back with our research team in just a bit from now. Stay with us.
Welcome back. The SGX Nifty is suggesting a strong start, a gain of 50 points at the open, but there is some selling emerging in Asia ex-Japan. So Nikkei is up nearly 1%, but the other markets, Hang Seng is under pressure. The Chinese markets are down 0.5%. The Korean markets are down more than 0.5%. So keep your eye out on Asia ex-Japan. But let's drill it down to the individual stocks. The research team is standing by with CNBC-TV18's list of top stocks for the day. And we've got to start with HDFC Limited and the bank and the merger. Abhishek.
Well, Rima, if you take a look at the swap ratio, it's about 42 to 25 is what the swap ratio is. So that means 42 shares of HDFC Bank will be given for every 25 shares that you own in HDFC Limited. So based on this swap ratio, if you do back of the envelope calculation, market cap of HDFC Limited will come to around 5.11 lakh crore. So current market cap is about 5.06 lakh crore. So gap is about 1.06% between the market cap based on the swap ratio and based on the current market cap. So there is a potential upside of about 1% based on the swap ratio available with us. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. So we'll be keeping an eye out on the HDFC Twins, but also on HDFC Life, because HDFC Limited went ahead and bought some shares yesterday. Surbhi joins us to fill us in with more details and how are things shaping up. Surbhi?
So HDFC bought 1.49 crores shares, which is close to 0.69% stake in HDFC Life for 992 odd crores. Now the merged entity currently, HDFC currently holds 48.65% stake in HDFC Life, and the merged entity has to increase stake to 50% prior to the effective dates. Another 0.66% of stake needs to be bought of HDFC Life between before the effective date. So that will happen between now and Friday.
Okay, thank you very much for that. Let's now go across to Vivek for some more stocks which are in the news.
Well, good morning. Quite a few stocks on the radar on the back of block deals as well as news flow. First on our list is Sapphire Foods. Yesterday, WWD Rudy, which held almost 4.77% stake in the company, completely exited its stake. And, some of the key buyers included Goldman Sachs, Society Generale, as well as Nomura India. The mother fund actually picked up a significant chunk over there. Also keep an eye out for Orchid Pharma. A few days back, the company launched fundraise via the QIP route. Yesterday, the company successfully closed this particular QIP, raising almost 400 crore at 425 rupees a share. Now, looking at some of the key buyers that picked up more than 5% stake via the QIP, Massachusetts Institute of Technology picked up almost 24% of the total QIP. Quant Mutual Fund via two schemes, Carnelian Structural Fund as well as Society Generale picked up significant chunks in the QIP. Watch out for Titagar Rail as well. The company has gone ahead and received an LOA, letter of award, for a project worth almost 875 crore. Now, this is from the Gujarat Mail Corporation for supply of gauge standard cars. And lastly, Gland Pharma, some positive news flow coming in. After a pre-approval inspection of the Hyderabad facility by the US FDA, the company received just one observation in the Form 483. So some relief coming in for Gland Pharma as well.
All right, Vivek, thanks very much for that. But more stocks with news flow. Sonal is standing by with that list. Sonal, morning.
Good morning, Prashant. Let me start with Ramco Cements because the company has commissioned line 3 at Ramamasmi Rajanagar at 3,000 tons per day capacity of clinkerization. So that stock is in focus. For TCNS Clothing, they have received approval from CCI for acquisition of TCNS Clothing by Aditya Birla Fashion. And BSE is in focus because now NSE has gone ahead, scrapped their plan to shift Nifty Bank F&O expiry to Friday. There is a joint press release which has come in from NSE and BSE where they talk about how proposed Friday expiry of Bank Nifty coincides with the expiry of the F&O contracts which was launched by BSE on 15th of May itself. And based on the market feedback, BSE feels that this could impact the growth of sensex or BankX derivatives which were launched by BSE. And that's why BSE requested NSE to consider shifting of the Bank Nifty expiry to any other day other than Friday, and that's why this particular notification was revoked.
Thank you for that. And let's do a quick recap then of the top stocks. Stocks with positive news flow are HDFC Limited, HDFC Bank, HDFC Life, Sapphire Foods, Orchid Pharma, Titagar Rail Systems, Gland Pharma, Ramco Systems, TCNS Clothing, and BSE. And there are no stocks on our radar with negative news flow this morning.
Okay, all right. Well, that's the top 10 list. But Abhishek is still with us to run us through some interesting brokerage notes that came in early today. Abhishek?
Well, Nigel, to begin with, UBS has written on BEL. They have a buy recommendation over there, and the target price has been raised to rupees 140 per share. They say that the company is well armed for return accretive growth going ahead, and they are on track for continued profitable growth going ahead. We have Bernstein, who have written on SDFC Bank. They reiterated their buy call, and the target price is about rupees 2,300. Now, SDFC Bank's management had announced an aspiration to achieve 30% operating efficiency, that is cost to income ratio, over the next decade. So I just did back of the envelope calculation. This ratio post the merger would be around 35% from the current level of 40.4% that you saw in FY23. This benchmark of 30% cost to income ratio as per Bernstein is seen with large Chinese and a few Middle Eastern banks. We also have CLSA, who have written on Tata Motors. They have a buy recommendation. Target price has been increased by rupees 50 per share to about rupees 690 per share. They say that JLR EBIT margin is likely to hit 6% by FY24. That is why they are raising the consolidated earnings forecast by 11% to 18% over the next couple of years, largely led by the higher margin estimate for JLR and CV business. We also have JP Morgan on RIL, who have an overweight rating and a target price of rupees 2,960 per share. They say that continue to see a stock offering attractive risk reward over the next 12-month basis. So while OTC supports earnings momentum in CY23, CY24 should benefit from multiple positive catalysts across telecom, retail, as well as lower capex intensity. Back to you.
Okay, well, Abhishek, thank you very much for that. So that's basically completes the list of stocks that you need to watch out for as we begin today's session. Deepan Mehta of Elixir Equities will join in for some fundamental stock check. Later, we'll have the management of Ramakrishna Forgings to talk about their recent order win. Stay tuned. Those conversations coming up in just a bit.
Welcome back to Bazaar Morning Call. Well, the setup is quite bullish. Unfortunately, the Asian markets have come off their highs. In fact, they're virtually at the low point of the day. But the SGX Nifty is promising that we're going to be getting closer to that mark of 18,888 or so. But plenty of stocks to discuss. So let's get straight to that. Deepan Mehta of Elixir Equities joins us on the show. Hi, Deepan. Morning, Deepan. I wanted to ask you about Bajaj Auto. They're all set to roll out their Triumph. I believe pricing out here in India will be out on July 5th. The launch was in London yesterday. 400cc. Pricing is going to be very, very important, actually. How do you approach the stock from here on? I mean, the prospects are looking up, both of the domestic, the exports, and then you have this new launch as well that's coming in. And coupled with that, tell us what's the view on the Royal Enfield? Because that had no competition. Suddenly you have a couple of bikes that are coming in there.
Yeah, good morning, Nigel, and thank you for having me on your show. Again, we are back to our favorite topic about the Royal Enfield. And, I've been a fan of that company, Eicher Motors disclosure, we and our clients are invested. And of course, I think there has been competition from time to time. There was Java as well as some of the other motorcycles also, which tried to make a dent. But I don't think the numbers are anything to talk about. And same, I think, goes with Triumph as well, although I think Bajaj Auto will try their best in terms of putting their marketing muscle behind the product. But the market also is growing pretty well, and there is space for many more players to come in this particular leisure bike segment with 350cc and above. So I'm not too concerned about the impact of Triumph on Eicher Motors. Coming to Bajaj Auto, I think certainly last 2-3 quarters they have done well. The average selling price has gone up, because of which the margins also have improved. And I think after a lull, you may see exports also starting to pick up for the company. So generally positive for Bajaj Auto. But as I said, I think in the two-wheeler space, the big elephant in the room is the way the EV sales are moving up for scooters and motorcycles. So that's something which needs to be tracked.
So now there are two auto stocks in the last 24 hours. Deepan, you said you like Eicher Motors, and yesterday you told us about Landmark Cars. What about RK Forging? We're going to be getting the management very soon. The company is looking to diversify away from autos. They're getting into non-auto. They're focusing on exports to just hedge and diversify their business. Do you like RK Forging? Have you tracked the business?
Good morning, Rima. Not very closely, because basically any company which is going into engine parts, we are not doing a coverage on it, because clearly the writing on the wall is that EVs are the future. And when it comes to auto ancillary, we want to focus on companies which are in the electronic space, which offer infotainment, security, sensors, anything to go with the car interiors, which go towards premiumization of the car or the commercial vehicle per se. And keeping that in mind, with usual disclosure, we are more positive on companies like Sona BLW or Minda Industries, which is now called Uno Minda, or Minda Corp for that matter. Maybe even a Motherson Sumi or Motherson Wire also may be interesting, because they're all focused on electronics which go into the vehicle and not so much about engine parts.
Okay, Deepan, hi, good morning. Any views on around this HDFC Bank, even HDFC Life actually? HDFC Life was, of course, the big mover. The bank has bought shares yesterday, as we were pointing out. Nimesh highlighted on this sort of D-Street chatter as well. And they've got some more to go. I mean, I think they've got to buy another 0.6%. And that should happen over the next couple of days. Any thoughts on HDFC Life and the other two as well?
So I think HDFC Life is fairly valued, and if you're holding shares of HDFC Life, of course, I wouldn't want to sell. But if you want to make a fresh investment in the insurance space, I think LIC offers a far better risk-return profile. And the reason for that is that a lot of LIC's enterprise values derive from movement of stock prices, and I'm sure their portfolio has done well where the markets have moved up. So more positive on LIC than any insurance company at this point of time. Disclosure, of course, required over here. And when it comes to HDFC Bank, I think after many, many months, we are seeing the end of a very big event. One big uncertainty is out of the way for HDFC Bank shareholders. And I think that the first 1 or 2 quarters which come from the combined entity could be the inflection point where the underperformance of HDFC Bank starts to get reversed. And I expect that they could get into a leadership position as well. So in any case, I think a lot of portfolios do have HDFC Bank or HDFC as part of their core holding, top 2-3 or so. And that I think should move, that I think should improve the returns even further on the investors' portfolio. So very positive on this merger, and it's a great event within the banking space of India as well.
Any view, Deepan, on Narayana Hrudayalaya? The stock has run away. Kotak, they've come out with the note. They've downgraded the stock to reduce. Any view on it?
Yeah, we're very positive on the hospital space, the medical space. I think it's one industry where it's going to see secular growth for several years. I think that medical spending is going to increase gradually in India as the overall consumption spending starts to look up, and many, many more elective surgeries are going to take place, and more spending is going to take place from the families as well. So I think that a company like Narayana Hrudayalaya, which follow generally an asset-light business model, are going to have a great time in the next 4 or 5 years or so. Of course, they can get overpriced from time to time. You could have a soft quarter or two, but very positive on the space. And I wouldn't want to sell Narayana Hrudayalaya at this point of time just because it got a bit expensive. Last 3 quarters numbers have been very impressive. And the management has a very well thought out plan to expand their capacity. So very positive on Narayana Hrudayalaya.
Deepan, stay on. We've got the management of Ramakrishna Forging waiting to chat with us. It's the first corporate on Bazaar today. The company has secured some big order wins recently. One was the Titagarh Rail Consortium, where together they won a contract worth 12,000 crore rupees from the Rail Ministry, and there were some contracts from EU as well, the European Union. We're now joined by Naresh Jalan, the MD of Ramakrishna Forging, to discuss more about this order win and the business outlook going ahead. Mr. Jalan, morning, and thank you very much for joining in. Could you give us an indication of how Q1 has shaped up? You've clocked in some very strong order wins. Has Q1 turned out to be better than what you were anticipating? What were the push and pull factors this time? And what does it set you up for the full year, FY24?
Good morning, Reena. I think, first of all, Q1 as a overall, I think we are satisfied with whatever we have been able to achieve till now. And I think for the full year, as guided, we are moving steadily towards our goal of 15 to 20% volume growth over FY23 last, whatever we closed. So I think we are on track to achieve the numbers which we have projected for the full year.
All right. Hi, good morning, Mr. Jalan. Nigel on this side. So, your stock price has moved up one way, 67% in this year so far. In the last 1 year, it's more than 170%. So clearly expectations are sky high. I wanted to focus on your European business. Out there you had told us that you work on attaining customers, you work with clients quite a lot, and then you manage to close them out. And I think as of last recorded, mid-teens is the contribution that comes in from the European business with tremendous potential to grow. Are you seeing any kind of signs of slowdown from the European business, or is it still looking up? And do you still look at that target of doubling your contribution from Europe?
We are still on track to double our contracts from Europe, and I think our business in Europe is steady and growing at a pace which we are looking at in terms of overall growth.
Okay, all right. And a quick counter question on your revenues itself. The non-auto part of your business, I think it was around 21% in the past year. And you've been saying that that's going to contribute more. So tell us, how does that shape up, say, in FY24, FY25? And just to confirm, non-auto margins are better than auto, right?
Yes, non-auto margins are slightly better than auto margins. And I think we are looking at close to around 25% of non-auto business in this year, and followed by almost 30% by FY25. That's our overall target of 70-30 mix of auto and non-auto for us.
Mr. Jain, all these, but the last time you joined us, you had said that FY25 revenues should be about 5,000 crores from 3,000 currently. I mean, these orders are all, that guidance bakes all of this in, or is there any sort of upside to the numbers as you see it as of now? Too early, I know, but any comments? Yeah.
No, I think we are steadily moving towards our overall goal of FY25, and I think we are in steady progress. So it's too early to comment whether there is an upside to it, but what we feel right now is the numbers are well within achievable targets.
You also had a debt of more than 1,000 crore rupees as of the end of March. How much will you be able to reduce it this year, and do you have a long-term debt reduction plan?
We have basically a debt reduction plan of close to 100-150 crores over every year, but we will stick to 1:1 debt to EBITDA. Right now, our debt EBITDA is 1:1.6. We are looking at in next 2 years to get it to almost at 1:1. That's the overall goal. So I think with the growth we are looking up in terms of overall top line and in terms of volumes, we will stick to 1:1 debt to EBITDA as our overall aim to have debt in our books.
You know, Mr. Jalan, the two exciting spaces with this street is getting very, focused on is your contribution from railways and EV. So for 2025, since you're in silent period, I don't accuse you too much on the near term, but with 2025 in mind, you said 5,000 crores is doable. Margins of around 22%. Can you hold on to that and can you improve on that? And also contribution coming in from both these two segments. I think railways, you were talking about moving towards 20% and EV towards 5%. Holding on to all these numbers?
I think in terms of margin, we are looking at holding the current level of margins and I think improving the margins. I think with non-auto sector improving going forward in next 2 years, I think our margin trajectory will look on the upward side. And in terms of EV, we are looking at almost close to 5% of our volumes by FY25 from EV sector. And in terms of railways, I think with non-auto going as high as 30% of our total order book in terms of auto and non-auto, the majority of this non-auto will come from Indian Railways.
Okay, we'll leave it there. Mr. Jalan, thank you very much for joining us. Good speaking with you, as always, here on CNBC-TV18. That's RK Forgings with perspective on how they see things panning out. You know, let's just have the SGX up briefly. Let's just do a quick Asian market check as well. And I think as Rima was pointing out, some of the Asian markets are lower in terms of trade. SGX is up 50 points, so indicating a good start. I mean, the trouble, of course, specifically, if you want to point out one market is China, to do with China-specific issues, some of the stimulus measures, etc., underwhelming the Chinese market. So both the mainland and the Hong Kong market have been underperforming massively for the last many sessions. Deepan is still, of course, with us. Deepan, any thoughts on a name like, basically the NBFC space, 5-star, for example? We had the management with us yesterday. 35% growth for the next 3 years is what their guidance is. Similar kind of growth guidance from smaller housing finance companies, etc., as well, like Home First. What do you like in this space?
Roshan, I think both these companies are very interesting. 5-star business, especially, I think the way they're going into tier 2, tier 3, I think that's their strategy to lend into SMEs into tier 2, tier 3. And it's got a great growth potential over there, limited competition. And the trick, of course, is to get the collection right and keep the NPs under control. And so far, I think they've done pretty well on that count. Stock, of course, is at a slight premium to the overall peer group, but the kind of growth rate that this company can generate, we're very positive on 5-star. Same with Home First also. I think all these new generation NBFCs, they're not competing directly with the established players. They're trying to find their niche either geographically or in terms of the segment that they lend to. And there's immense potential when it comes to tier 2, tier 3, or to lend to the kind of population which is not that organized or not the non-salaried classes, I would say. Because that's where the challenges come in terms of determining their ability to repay. And if you got that formula right, I think the growth rates can be significantly higher. So positive on both these companies, and you could look at investing in them. These are great times for banks and NBFCs, and smaller companies like this will certainly outperform the larger ones.
Any thoughts on something like Delta? Yesterday, Delta made a very sharp up move, 4% higher, pretty strong volumes. What's driving the stock move here?
See, the thing about Delta and Rima is that they are adding, I think, one more boat, and which is going to double their total, I would say, tables available. I don't know the exact terminology which they use, or the positions available for providing to their customers the gambling options. And the way I think overall travel tourism is shaping up, and overall, I think, when it comes to having this kind of entertainment, perhaps is the only medium available on the listed space. So keeping that in mind, we have a positive outlook on Delta. It's a company in which we have invested for many, many years and not seen any great returns. But I think now it's reaching a point where it'll start to perform pretty well. They have a large plan to set an onshore casino as well, a complete kind of I would say, hotel, come convention center, as well as many gaming positions over there. So that's a long-term plan, of course. But on the whole, I think the company certainly merits a more deeper look at it, and it could turn out to be a dark horse and a great winner going ahead. They want to hive off their digital subsidiary. Let's see how that also shapes up. But broadly positive on Delta. I think it's one company which has not lived up to its true potential. But it may suddenly change that from this point on.
Okay, so adding aboard, they've got plans to build an onshore casino and hive off their digital business. So there are a few long-term triggers for Delta Corp. Let's see whether they can realize it. Need to slip into a very short break. Dipan, do stay on. On the other side, we'll get Anuj Singhal for a quick trade setup.
Okay, welcome back. There's 13 minutes to go for the pre-open session. SGX still indicating a 50-odd point higher start. Anuj is here with a quick check on things in terms of how he's looking at the trade setup. Anuj, morning.
Morning, Prashant, Nigel. Well, you know what? The market expected our setup yesterday, ended at day's high. And I did expect a rally in HDFC Twins, but not to the extent that it happened. Of course, there was this news, but that led to this big surge in Fin Nifty. And also the Bank Nifty, which broke out. Now, that was one index which was having some troubles breaking out. But finally, we closed above 44,100, which is the first close above this level since June 7. And since that day, we have had 4 instances where the Bank Nifty has stopped before 44,100. So in that sense, yesterday's breakout was important. The broader market has also stabilized. The big question is, will the Nifty finally cross 18,888 or reject it once again, like it's done 3 or 4 times in the past? I mean, even if it does it again, we all know that it will hit that and sustain above that at some point. There's monthly expiry today. The momentum is with the bulls. Just to explain those FII numbers, yesterday there was 56 lakh delivery buying in HDFC, 68%. and 85 lakh shares in HDFC Bank, 50%, and 1,600 crores of delivery buying in HDFC, 1,500 crores of delivery buying in HDFC Bank. I've been making this point that, HDFC twins, from now on, you'll start to see a lot of upgrades from brokerages. You saw Goldman earlier, Bernstein today, and my sense is you will see over the next few days, few more upgrades. Today I'm not really talking about the nifty levels because you're so close to all-time high, but really life at new high. And my sense is that the market's still not shown euphoria signs. The number of stocks at new 52-week high is still just about 132. I mean, that number is not even alarming till the time you get to at least 300 or 400. So that's okay. The only red flag has been the promoter and insider selling via the block deals. Autos, FMCG and financials will continue to lead the market even at new all-time highs. But large cap IT has started to show some signs of bottom. And I think next week you have the earnings season which starts, or a little after that. Last quarter was good. So let's see. The market, of course, right now at 19 times on aggregate. Not very cheap, but not very expensive either. My sense is we are ready for life at new all-time highs.
And if you do it with momentum, with enthusiasm, all the better, right?
Absolutely.
I mean, it kind of tells you that there is more to go. So, that's the right way to do it. Anuj, thanks very much for that. Mitesh and Srikanth are with us with what they're making of things and specific trade setups as well. Mitesh, good morning. First to you, how are you looking at things? The Nifty Bank is back above the 20-day as well. Nifty, of course, did what it did, and mid-caps and small caps were firing. What's the setup?
Morning, Prashant. So yesterday morning, sometime, when we started getting past 18,760, we took a long trade on the Nifty, and towards the last hour, we took a long trade on the Bank Nifty. After consolidation, the intraday indicators were looking up again, and I think that should see the Nifty attempt and possibly get past the recent highs of 18,880. I am penciling in an aggressive target of 19,000, 19,030 on the Nifty, and with the gap up today, I think it's about 50 odd points as the SGX is indicating. What we'll do is we'll take the stop loss trailing to just about 10 points below yesterday's high. So I think we'll trade with long bias. The good thing was that in this entire consolidation and contraction, the breadth always remained positive. The broader markets were always supportive. And now with the large cap stocks joining in, especially the banking pack as well, I think we should see a good momentum for the next 1-2 days.
Okay. All right. Mitesh, thanks for that. Srikanth, what about you? Maybe or not, we're going to be going to that golden figure, 18,888. No teasing today. I guess we'll go ahead and make it. But how do you approach the index?
Good morning, Nigel. Yeah, I think so, like the way yesterday the market recovered and the way it has broken almost all its important levels, I think we are on the verge of crossing this 18,900 levels in the first half. And if it happens that, then 18,000, then the support will shift to 18,800 from the levels of 18,700. So in case if there is any specific dismissal in the first half, and if there is any intraday correction, then we should be buying in the market. I think now 18,800 is going to act as support for the market. But if it fails to cross that, then again it is going to remain in a range. That's the overall view. But the way, as Mitesh said, Bank Nifty also recovered from the lower levels and it closed above the mark of 44,000. I think it will help the market to move higher. And most of the banks like State Bank of India, ICICI Bank, they were under huge selling pressure or profit-taking pressure. But now, based on their charts, we are of the view that that pressure is now releasing. So it will help the broader market to move higher. That's the overall view. And in case Bank Nifty crosses 44,500, then it will also move towards 45,000. So broadly, the strategy should be to buy on dips.
Okay, got that. Mitesh, in terms of specific trades, what do you have?
Yeah. So Prashant, after a long time, an all buy list for me. HDFC AMC, disclaimer, we have some positions here. That's a buy with a stop below 2,000 for a targets of 2150. LTIM, which is the Mindtree stock, that's a buy with a stop at 5,100 for targets of around 5,300 or 5,300. Also a buy on Jindal Steel, where I would recommend taking positions with a stop at 573 for targets of 600. And Delta Corp is a buy with a stop at 243 for targets of 260.
Srikanth, what would your recommendations be on individual stocks?
Yeah, good morning, Rima. I think, see, from the bank space or from the BFSI space, we like ICICI Bank. The reason is because it has consolidated or spent time close to 920, 915 levels. And from there, all the way it recovered back to 930, which is positive. So from the, based on the daily pattern, we are expecting stock to move towards 960. 965. So it's a buy at current levels with a stop loss around 925. And the other stock which we like is Tech Mahindra, which is currently around 1120, 1125. So from here, the again stock can move towards 1200. I think a few IT companies are definitely going to do well in the near term. That's the overall view. So Tech Mahindra is also a buy at current levels with a stop loss at 1100.
Tech Mahindra is a buy call. Thank you very much, gentlemen, for joining in. We also have Rajesh Palvia, VP Technical and Derivative Research at Axis Securities, joining us on the show. Rajesh, important day, expiry. Do you think the Nifty can conquer those all-time high levels? What's the setup looking?
Yeah, good morning. So in the previous session, we have seen a strong short covering action. Most of the call writers have covered their position for all the strikes at 18,700, 18,800. So it clearly shows that, this momentum can continue further higher in the today's session also. And yes, Nifty is likely to complete its unfinished agenda of all-time high in today's session. So chances are very much to scale up to the new all-time high in the today's session. Looking at the data setup, we do believe that once Nifty manages to cross all-time high level, then this rally can extend further and possibly Nifty can scale up to the level of 19,000, even 19,200 in the continuation of this uptrend. As we look at the overall data setup, if we look at the overall market breadth and the participation from the mid-cap, small-cap, and all sectors on the rotational basis are contributing to this rally, it clearly indicates that the market is now going to continue furthermore upside once we crosses this all-time high trajectory. To play this upward momentum, we are initiating here again, to buy 18,800 call option of next weekly expiry of 6 July. Which was closed at around 127 rupees. We are projecting target of 170 to 180 for this call option. Keep stop loss of 95. Even on the Bank Nifty also, we have witnessed a strong short covering action. And now if we continues to hold above 44,000 level, then another round of short covering we can expect in the today's session. And possibly Bank Nifty can scale up to the level of 44,400 to 44,500. And so again, Bank Nifty is also on the buying side. On the stocks front, we expect Piramal Enterprises can do well in today's session. Strong buying action in the previous session. So we are projecting target of 935 to 940. Keep stop loss of 890 to buy Piramal Enterprises. Another stock is from pharma space, that is Zydus Life. Stock clearly outperforming, and in the previous session, stock has shown breakout on the daily as well as on the weekly time frame. Looking at the breakout, the kind of addition throughout the series on the data, we expect Zydus Life can continue further higher. 600 to 610 is the immediate target we are projecting. Keep stop loss of 560. Another stock we like, that is ICICI Prudential. Most of the insurance stocks have done well, and ICICI Pru is also catching up, and the kind of addition we have witnessed in the previous session, we expect this stock can continue further towards 610. Keep stop loss of 568 to buy ICICI Pru.
Okay, thank you very much for joining in. We'll get into a break. When we return, we'll have the pre-opening rates. We'll also be joined by Sriram Velayudhan of IIFL Securities to discuss about the HDFC Twins merger. Stay tuned.
Okay, welcome back. There's about a minute to go for the pre-open session. There have been some changes, technical aspects, the holiday being shifted, expiry today, the NSE in a circular basically saying that they are withdrawing the prior circular where they were moving expiry to Friday instead of Thursday. So a bunch of things. We thought, why not speak with Rajesh Baheti, Managing Director at Crosseys Capital Services, to get a quick perspective on this. Rajesh, let's just start with the Bank Nifty expiry postponement and then the withdrawal of that postponement. So expiry on Thursday still. What do you make of it?
So, you've seen the recent launches by the NSE when you spoke about the Fin Nifty when they changed the expiry to Tuesday, as well as the mid-cap expiry on Wednesday kind of helped these indices get some traction. Bank Nifty and Nifty were both expiring on the same day, and I think to some extent the Bank Nifty was eating into Nifty's volume. So from a purely competitive point of view, it made sense for the NSE to kind of have two expiries for the Nifty and Bank Nifty just to get more bang for the buck in terms of revenue. So from that point of view, I think it was a move designed to add volumes to these segments so that they don't eat into each other's volumes on expiry days, which were common.
No, will this, that's fine, that's NSE, but will this help BSE in a big way, in your opinion?
No. So now what has happened is that the BSE has just launched its sensex expiries on Friday. It was a fledgling product. It was picking up traction after a very, 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 very long time. We saw some F&O activity in the BSE happening. And I think the fact that Ashish Chauhan has recently joined NSE and was at the helm of BSE for 10 to 15 years, I think helped the patch up and had the NSE withdraw its move to the Friday expiry maybe by 3 to 6 months to allow the BSE indices to settle down into some kind of a rhythm where a competing product won't affect the volumes too much.
So Rajesh, this is only a temporary move for the next 3 to 6 months, and then eventually we will see NSE coinciding its expiry with that of BSE, according to you?
Yeah, I mean, if the exchanges are to compete and collaborate, I would say that they would collaborate for some time. But I think it would be foolish to think that the NSE will continue to accommodate the BSE forever. I think the BSE has recently relaunched this product. It's seen some traction, and I think in good neighborliness and friendliness, the NSE might have withdrawn this for now and said, okay, you take 3 to 6 months. Afterwards, the gloves are off. So probably it's my thinking that it's a 6-month delay at max.
Since we have you, Rajesh, briefly, any thoughts on the shifting of the expiry because of the holiday? The holiday was supposed to be today, market holiday, and then tomorrow, so expiry today. Any thoughts? I mean, does it impact positions and how one accounts for these things?
Yes, it does. If you look at the way the Greeks kind of move, irrespective of whether there's a trading holiday in between. I mean, 2 days ago we had 3 days left for expiry. Suddenly it's 2 days left for expiry. That's 33% of the option premium knocked off. So there is obviously some premium that still plays out if a holiday comes in between. But if the expiry gets preponed, then those days actually get knocked off the system. So to that extent, it must have affected the option premiums, and the sellers might have profited from it. At the same time, I think there's not much NSE could have done if the government changed the public holiday.
Rajesh, we'll leave the discussion here. Thank you very much for joining in and throwing light on this topic. Let's move on. The merger of HDFC Limited and HDFC Bank may become effective from the 1st of July, and the HDFC stock is expected to delist from the 13th of July. Sriram Velayudhan, the Vice President at IFL Alternate Research, IFL Securities, is now with us on the show. Sriram, the big question now is who will replace HDFC Limited in the key indices? And your thoughts, the name, and how have you arrived at that?
Hi, Ima. Very good morning.
Good morning.
HDFC and HDFC Bank merger has been a key event both from a special situation merger perspective and index reval as well. Now that we are nearing the completion of this event, market will shift its focus to stocks that are likely to replace HDFC Limited from the key indices like Nifty 50, Sensex 30, and how the impact would be in MSCI India. We have done some analysis. We have been closely tracking this event because there is a good deal of repositioning that can be done in these names. So in case of Nifty 50, we expect LTI Mindtree, which is LTIM, to be the strongest candidate at this point in time to replace HDFC. While in case of Sensex, we expect JSW Steel to get added in place of HDFC Limited. Now, coming to MSCI India, as we all know, in the month of May, the index provider came out with a very important announcement so as to avoid the challenge of a reverse turnover. So with HDFC Bank expected to get added with an adjustment factor of half in place of HDFC Limited, we expect this event to be largely a neutral event because it might lead to mild sell flows of 255 million odd. Because passive managers, they just will have to, act on this part. There is no requirement on the MSCI passive trackers to do the adjustments. The entitlement of HDFC Limited itself will provide them access to HDFC Bank as on the effective date. So in terms of a net outflow, which amounts to $255 million, it's not that big.
All right. Hi, Sriram. Good morning. Nigel on this side. Sriram, LTI, Mindtree we're watching out for, and JSW Steel. There would be some pre-positioning, right? What kind of flows are you estimating? If this happens, what kind of inflows could it see into both these two stocks?
Sure. Hi, Nigel. Good morning. So in case of LTIM, we are expecting inflows of roughly $166 million, which is 7 days ADV. And on JSW Steel's addition in sensex, we expect this to be an inflow event of $160 million, which is roughly 5 days of impact.
Okay. Got it. All right. Sriram, the other question that we keep getting is, what about DMART? The criteria, it's not being met currently. It's not part of F&O, so it can't come into the Nifty. But whenever it gets included in F&O, is there a cooling off period before it gets eligible for Nifty? Does it have to be traded in F&O for 3 months, 6 months? Or the day it comes into F&O, it's eligible to get included in the Nifty at the next review. I ask you this because plenty of questions coming in on that. And if it wasn't for this F&O criteria, actually that would be the biggest candidate to get into the Nifty.
Yes, I tried, Nigel. So in terms of the stock fulfilling the criteria to get included in F&O, it definitely is. But this is something which is a subjective call. Taken by the concerned authorities whether to include a stock or not. He has rightly pointed out there isn't any cooling off period. The moment the stock gets introduced in, hypothetically, in a situation, if it gets introduced in F&O, it becomes eligible, a candidate to get included in Nifty 50. Even in terms of average float market cap and all, it's higher as compared to LTI Mindtree at this point in time.
I just want to say one thing, that the pre-open indicates that we are going to be opening at all-time highs. Let's just have the Nifty up. Sri, I'm just coming back to you. Look at the Nifty, 18,900 plus on the Nifty, according to the pre-open, which basically gets us above that 18,888 level, which is the prior high made in December of 22. So that's what we have. So it's going to be interesting as we open in the next, 6 minutes or so at 9:15. The pre-open in the Nifty indicating a new all-time high. Guys.
All right. Sriram, the other event that we're looking forward to is the MSCI changes, right? In the coming month or so. What are you factoring in terms of a rejig over there?
Sure. It's one of the keenly followed events, especially after the index provider decided to shift it to a more comprehensive one at the start of this year. So in terms of expectations of inclusions, our high potential inclusions would be Cummins India Kirloskar, Astral, Power Finance, and IDFC First Bank. So these four names, stands the strongest of the chances in terms of getting included in the MSCI India Standard Index. The other medium probability names would be Ashok Leyland and HDFC Asset Management. For both these names, a lot will depend on the price action in the run-up to the cutoff. One more name which I will have on my radar would be IndusInd Bank. Because to everyone's surprise, the foreign room had opened up when the March shareholding disclosure was out. So foreign room will be a key monitorable here. let's say if it opens above the threshold required for inclusion, this again will be a candidate that can become part of the MSCI Standard Index for August.
Okay, all right, Sriram, thanks so much for stopping by and giving us all those details. So expectations are LTI Mindtree comes in place of HDFC Limited. You'll have JSW Steel that comes in place of HDFC Limited, but that's in sensex. LTI Mindtree comes in the Nifty. And also we could see a more or less neutral reaction on the HDFC twins. Mitesh Thakkar is back with us for his 9:10 call. Mitesh, what do you have for us?
I have actually LTI and Jindal Steel as my stock picks among my stock recommendations. Let's see if LTIM, doesn't open with a very big gap, then I think it can be taken with a stop at 5,100 for a first target of 5,300.
Okay, all right. Thanks a lot for that, Mitesh. We'll come back to you during the course of the show. But Mangalam joins us to talk about a couple of top stocks that we're tracking. Zomato is one such stock. What's the read-through, Mangalam, from Swiggy's numbers?
Well, so Prosus releases a report on Swiggy every year, and Jefferies has picked up from the Prosus report. So the report is pretty simple. The fact is that there was a slowdown in the second half of calendar 2022, which we saw in Zomato as well. But at the same time, these companies grew, in their profitability. So that's a big positive. The key data points is that Swiggy's food delivery GMV grew at about 10%. Over the first half in the second half of 2022, but the losses saw a sharp reduction, which trends similar to what the broader internet strategy has been. Food delivery achieved break-even and similar to Zomato for Swiggy as well, but the big part was their quick commerce business grew nearly 6 times over the last year, and that's something that we saw in terms of growth for Blinkit as well. However, the standout part of this is the steady decline in market share of Swiggy. In 2020, Swiggy's market share was a little over 52%, then declined to 47%. And the first half of 2022, it has fallen to 45% itself. And Jefferies believes that this has fallen further because Jan 23 onwards, Zomato introduced, or rather reintroduced the Zomato Gold. So as a result of it, some users would go there anyway. In terms of footprint, Zomato has 750 cities. However, in terms of active delivery partners and active restaurants, Swiggy has an edge over Zomato, but things are improving for Zomato. They may gain a little more market share and profitability boosted for the sector.
Thank you very much for that. Another stock that we're looking at today is Tata Motors, because CLSA has increased the target price on Tata Motors to 690 versus 624. The reason for the increase in the stock price and the valuation is because they are expecting higher margins for the JLR business and their CV business. So when it comes to the JLR business, they're saying 76% of JLR's order book is comprised of high margin models like the Defender, Range Rover Sport, and secondly, incentives are subdued, which is why they're now penciling 6% plus EBITDA margins on JLR. The second reason is higher margins in the CV business. So the CLSA has gone ahead and increased the EBITDA margins on the CV business of Tata Motors because commodity prices have declined compared to the Q4 levels and pricing is stable. So they're now expecting margins to hit double digit next year for the CV business at 10.5%, which is in line with the management's guidance of double digit margins. So you've got CLSA upping the target price on Tata Motors to 690 because they're now expecting higher margins for the JLR business and also for their CV business. But just close to the market opening.
All right,
now.
just a few seconds, then we're going to be opening at those fresh all-time highs on the Nifty. It was teasing us for the last 10, 20 sessions or so. But we're finally there, 18,908. That's the early indication that we're going to be opening up. That's above the December 1st high of 18,888. So a big move is what we've seen in the recent past. And, just a few seconds from now, we're likely to see that number. Remember, from the lows that we saw in March, actually, we're up 12.2%. We're up close to around 2,000 points odd. So it's been a good pullback after the lows that we saw from March itself. And now, in fact, we're bracing for that. Holding on to these levels, though, that's going to be crucial because today's expiry day as well, the bears seem to be stuck on the wrong side, but holding on to these levels are crucial. There it is, fresh all-time highs on the Nifty. We're holding above those levels, and as we hit that mark, some bit of an algo trade would have played out. That's why we're seeing some bit of profit taking from those highs as well. But it's the record that we're waiting for. We have hit that number, and after the teasing for the last many, many sessions, the fresh all-time high is made. And the stocks that are doing well today, you have Tata Motors that's at the high point of the day. SBI as well is doing quite well. Titan is one of the winners in there. On the flip side, you have HDFC Life, ONGC Cipla from the Nifty pack as well. That's seeing some bit of selling. But guys, we're finally there, right? Prashant, you said not to talk about the last few sessions. We didn't talk about it. Yesterday, the HDFC booster short came in there. Yeah. Maybe an expiry-related factor as well plays out. And that's why we breached those all-time highs, but we have come off. So that program trade seems to be playing out as well.
You know, it's incredible, right, Nigel? For the year, we are up 4%.
Yeah.
A 4% gain has basically pushed us over new all-time highs. Usually, I mean, you know, it would be longer, it would be more long, sort of, you know, the gains which you accumulate from the previous levels would be much larger. But this is 4%, 6-month wait, and you're basically back
at 7 months. Last year was quite extraordinary because the lows were made at the beginning of the year when you had the Russia-Ukraine crisis, and the highs were made right at the end of the year. So I'm saying last year, in a way, was extraordinary because the base of your all-time high effect globally came in right towards the end. And for us, it was 1st of December. So after, I think, 140 plus sessions, we're back to our all-time high levels.
Yeah, no, absolutely. I have to say that, you know, things are looking pretty good all around. They've been looking good pretty much all around. But what happens from here is the question. I mean, we got to within 1 point to the high. So the high was, in a way, not in the bag. I mean, you hit it and then you hit it. But the point is that it was coming. So we are there. But what now from here, I think, is the question which we'll need to kind of focus on. And there are lots of variables which we will continue to highlight as we go forward. From a purely price action perspective, why a new all-time high matters is because you don't have reference points. You don't have it's blue skies in that sense about in terms of projecting targets and stuff like that. And we've done that this morning with taking out the previous all-time high. And I think we are one of the first large markets in the world to reclaim our all-time highs. Many markets around the world have got to their 52-week highs, but I think the market here in India perhaps is the first one which is back at all-time high levels. Let's get some views in. Nilesh Shah is joining us, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, good morning. Great to have you with us here on the show. Might I add, congratulations. New highs finally. What do you make of it? What do you make of the mood, the environment, and trajectory for markets from here out?
So one, there is a Triveni Sangam of flows, sentiment, and fundamentals for India. Flows led by domestic investors, foreign investors, retail HNI. There is a lot of demand for Indian stock and limited supply. IPO season is beginning, but it has not reached peak like our monsoon. Second, sentiments are positive in India. We remain one of the fastest growing major economy with macroeconomic indicators which are very, very positive. And finally, it is the fundamentals which prevail over flows and sentiments over a long period of time. On a near-term basis, we remain one of the expensive market in emerging market. But if you take a longer-term view, then we remain one of the cheapest market. So this is a Triveni Sangam of flows, sentiments, and fundamentals.
Nilesh, I was seeing one statistic which shows that the Indian market up move this time in the last 6 months has been very broad-based compared to what we are seeing globally. So the percentage of stocks above the 200-day moving average as of yesterday in the Indian market was about 75%, which is higher than the 68% level that we had in December of last year when we had got to those previous high levels. So the rally in India, unlike in the global markets, has also been very, very broad-based. And we've seen a near 20% up move in the mid and the small cap index since March. Nilesh, any signs of euphoria? Typically, when markets get to all-time high levels, you've got, the bullish indicators pretty much peaking out. This time, how are you sensing the sentiment in the market? Any signs of euphoria which indicates that we could enter a period of fatigue or correction or reversal?
So euphoria, I wouldn't say, but optimism, undoubtedly, yes. As I mentioned, this is flow-driven rally to begin with, where there are many buyers and far less supply. Private equity funds are providing supply, balance advantage funds are providing supply. But bearing that, the IPO, OFS, QIP season has not yet begun. And invariably in such kind of scenario where demand is outstripping supply, buyers are more aggressive than sellers, there will be some amount of optimism. We haven't reached euphoric valuation for the market. Of course, there are certain stocks where valuations are defying gravity. There are some small and mid-cap stocks where I will urge caution because there is a wide gap between their prices, valuation, and fundamentals. But on a broad level basis, market is not euphoric. It is optimist. Valuations are at the higher end of fair value, but it is not expensive valuation like, let's say, it was in 2008.
All right, Nilesh, just hold on to that thought. You have these Adani Group stocks, where there's a very large trade that's taken place with Adani Enterprises. It's up, close to around 1.5%. Equity has changed hands on Adani Enterprises. Even Adani Green, the volumes are very, very high. In a couple of minutes, you have close to 5 crore shares that are traded on that counter as well. So just keep an eye out on a couple of these names. Big volumes is what you're seeing on them. Nilesh, good to see all-time highs, but some caution needs to be thrown in as well. What would be the factors you're considering? Maybe it could be earnings, the monsoons as well. Maybe the street is anticipating very high earnings, or do you think we get them? And the monsoons as well could be a bit of a headwind, right? Hopefully things pick up there.
So to some extent, our economy has, get some resistance power against adverse monsoon. So undoubtedly, we'll have to keep an eye on monsoon, but it's more likely to be a speed breaker than a U-turn. For us, the bigger challenge is one central election 2024. What kind of government formation and political process will be there? We have seen in 2004 as well as 2009 as well as 14 and 19 last 4 attempts. We have seen an impact on market on a short-term basis because of election results coming either in line or against the expectations of the market. The second thing to keep a watch is Fed and RBI pivot. Clearly, inflation is coming down, but not at the pace which will allow elbow room to Fed to cut the rates. Will they raise rates? How much they will raise rates? When will they cut? Will they take out liquidity? All these factors will have material impact on our market in the near term. Over longer term, what matters is earnings. This year, earnings growth is about 10%. Next year, market is expecting, as usual, about 15 to 18%. We think that earnings growth is unlikely to be delivered. We should be more towards, 10 to 12% kind of earnings growth next year. So how does market weave in this earning deceleration? All those factors will continue to have volatility in market. But one thing is reasonably sure, that at lower level, there are likely to be more buyers than sellers.
So, Nilesh, completely agree. Optimistic, but no, not euphoric. I mean, maybe some euphoria in some parts of mid-caps and small caps, etc. But that's always the case, right? I mean, you can't avoid that. But on frontline indices and all, nothing. I mean, no euphoria at all. Just to take off from the last point that you mentioned, so longer... Basically, what you're saying is longer bull phases, very shorter and short-lived bear phases in that sense. I mean, that's the roadmap one should expect, broadly. I think we lost that line with Nilesh.
Largest economy.
Okay, I think we have Nilesh back. Nilesh, sorry, we lost you there for a second. Go on, please.
Sorry. So we are moving from 10th largest economy to 5th largest economy over last decade. And now we are moving towards 3rd largest economy. What we saw over 30 years in terms of GDP and market cap creation, we are likely to see over next decade or so. In that journey, undoubtedly stock prices will get supported. And as I mentioned, we have to deliver on the 3G of growth, governance, and green transformation. Our earnings growth has to be better than peer group. Our governance standards has to be better than peer group. And our economy should transform towards green economy better than peer groups. If we deliver this 3G of green growth and governance, I have no doubt in my mind that we are on a longer term bull market. Of course, it will get punctuated short-term volatility, but at every correction, it will be a buying opportunity, provided we deliver on this 3G.
Nilesh, if we could just request you to stay on. Markets are at a record high, but we want to take stock of the individual gainers and losers in this big up move on this momentous day. Mangalam is here at the big wall. Mangalam.
142 trading sessions and a 4% gain on the Nifty is what it took for it to hit a fresh record high once again after December 1st. Sensex up by that much as well. Nifty Bank, however, has been a lack of participant in this up move, 2.6% in terms of gains. But this gain really, or this move to the record high really belongs to the small caps as well as the mid cap indices, both of them up in double digits in this year itself. And it also belongs to a lot of the domestic sectors. As you would see, the realty sector, the FMCG sector and the auto sectors have been the ones which have done extremely well, whereas the global facing sectors like IT and metals have seen a bit of a decline in this year itself. India versus the world, we've seen a big rally come by, but we've seen an even bigger rally come by on, indices like Nasdaq, Nikkei, the German index and S&P 500. But that's also because they fell a lot more in the previous year than the Nifty itself. What are the indices we've done better than? We've done better than Dow Jones, we've done better than FTSE, we've done as good or slightly better than Shanghai as well. Even as the frontline indices are at a record high, remember the small cap index is still 9% away from a record high. So let's see where that goes. This rally picked up as, we saw the FII flows pick up as well. Start from March, April, May, we had that record month, almost 28,000 crores coming in from the FIIs. And in June itself, so far, we've seen almost $1 billion come by in the cash market. What are the key triggers and reasons for the FII flows for our market picking up? The biggest one, of course, is the Indian macros doing a lot better than global macros. So that's one big reason. The second, domestic themes in India doing extremely well. The third thing that we're looking at is stable crude cooling inflation, bodes well for the Indian macros as well. And as FII flows pick up, we also see higher emerging market flows coming into India versus China. So that was one theme that played out. In terms of stocks, the topmost gainer on the Nifty was Tata Motors this year so far. ITC doing extremely well, leading the FMCG index higher, and entry-level autos doing well. So Bajaj Auto up 28%. Among the losers, we had Infosys and Hindalco among the big losers. Adani Group stocks also took a bit of a beating. So this year, we saw that. In the mid-cap gainers, pharmaceutical names found some mention. So Aurobindo Pharma up 64%, Glenmark Pharma up 55%, ABB doing extremely well as well, with defense themes like HAL up 45%. In terms of losers, we had a lot of stocks which lost on account of their individual news pieces. So we had ACC lower, Z Entertainment lower, AB Fashion because of valuation, City Union Bank lower as well. But the stars were definitely the small caps. So we saw names like Balu Forge, we haven't heard of, up 160% this year. Titagar up around 125%, Zentech 124% as well. And big gains coming in for Chennai Petro and RVNL 2. But with all of this, just keep an eye on the valuations. The Nifty on a one-year forward basis currently trades at 19 times, which is pretty much in line with its historical average valuations. And going forward, a couple of factors we need to watch out for. One will be the way the global markets pan out and interest rates globally. Flows into other emerging markets versus India as they pick up is something we'll be watching out for. Monsoons, festive season, all that bodes to domestic demand recovery in the second half. Will that continue or not? And then there are a bunch of state elections in India as well, all of them leading up to next year's central election.
Oh, thank you very much for that. Balu Forge, that's the first time I've actually heard of this company. It's a 1,400 crore market capitalization company. But Nilesh,
Nimesh had put out on his D-Street chatter.
Oh, I think I missed it.
Yeah, Ashish Kacholia, one of the investors, had picked up a stake. I think this was just about a week and a half out back. But the stock's not phenomenally well, as Mangalam said.
All right. Nilesh, just want to talk a bit about the flows, right? That's been one of the three drivers of where we are today. While the FI flows have been strong, the retail inflows via the SIP route have been steady. Are you sensing some disenchantment with the HNI community? Because when we look at the discretionary spending or the big HNI inflows into the Indian market, it's been absent or not roaring the way we've seen with respect to the FI inflows. Is that something a bit of a worry, or what's leading to that? Is this something that you've observed too?
So in the SIP, Rima, now it is no longer just pure retail. I have known clients who are putting in crores of rupees via SIP into market. Many HNIs and family offices have also recognized that it is impossible to time the market. There is no harm in trying to put some amount of your wealth into market through SIP. They all earn regular income and they are doing SIPs. The second thing possibly, and HNI is a very, very intelligent and large segment. So there are pockets with divergence behavior. my feeling is that there are still some HNIs who are sitting on cash, who were waiting for correction to enter into market, and they found the market momentum little bit against their expectation. My feeling is that those money will probably wait for correction to enter, and which is why I mentioned that today investor has matured a lot. Generally, when markets are in momentum or rising, we are seeing SIP minus redemption and net flows dwindle. And generally, when markets are cheap and falling, it is SIP plus subscription, and suddenly we invest lots of money at lower level.
Okay, all right. And Nilesh, thank you very much for joining us. Once again, thank you very much for joining us on this day when the Nifty finally makes a new high. Appreciate it. Appreciate your time here on CNBC-TV18. Shankar Sharma is joining us, founder of G Quant Investec. Shankar, good morning. Finally, at new highs on the Nifty. You've been telling us about this lake of return theory. Sorry if I'm getting that correct. Or if I mispronounced it. Yes. Is the lake closer to being full? Is it half full? Is it overflowing? Where are we?
No, lake is, I think, about half full. Good morning, Prashant, and good morning to the rest of the guys. I can't see you, but, it's good to be chatting with you guys again. So, yes, so the lake of returns theory is the correct name. And thank you for not calling me a market veteran, because I do not look like a veteran, as you are clearly aware by now, at least. So, right. So, yes, it is obviously filling up. It was very, very low at the point of the March 2020 crash, when the sensex, I think, fell to 37,000. And at that point, the market had returned. Even actually prior to that, the sensex had a very, very poor run for about 10 years, beginning 2010. It had compounded at barely, I think, 3 or 4%, which was well below even fixed deposit returns. So the lake was really empty. Lake was near the lows. And from the point the COVID happened, the lake started to fill very rapidly. So we went down to 37. Now we have almost doubled, not doubled, but nearly doubled from those levels. But if you still see from a point to point from 2010 up until 2023, it is a decent return, but not anywhere close to overflow levels. Not anywhere close to overflow levels. And I want to emphasize this, because overflow will mean that markets for 2-3 years give you absolutely tear-away returns like, 30, 40, 50% compounding. We have not done anything close to that, Prashant. If I look back at the point at which I called the 2008 bear market, that didn't come out of the subprime per se. It came out of more the fact that in the preceding 3-4 years, from 2003-4 up until 2007 December, our markets, as well as global markets, had delivered like in excess of 50% CAGR. Now, that lake was overflowing. That lake simply could not hold on to that much inflow of water or returns, if you will. So this lake is definitely nowhere close to being full, and that is the good news.
All right. Hi, Shankar. Good morning. Nigel on this side. Shankar, let's talk about the smaller lake then, the small and the mid caps. Well, the party has been there, right? After many years of underperformance, actually. We have seen a good outperformance in the last 3 months or so. How do you position yourself out there? As you have been stating various times in the past, the big party will be there in the small and the mid cap space. Tell us more about that from here on.
So yes, it's a small lake, the kiddies pool. Was actually very empty till about, I think, 6 months back, while the markets, the broader market, let's say not the broader, but the larger caps is represented by the sensex and the Nifty were doing reasonably well. They were hovering around between 58 to 62,000 sensex levels. The small cap index, the BSE small cap, which is a fairly good index, was at least, I think, 15-18% away from its size. So that lake was extremely low in terms of returns. Again, go back in time, 2018 was, I think, if I'm not mistaken, January was the peak of the small cap market, and then it basically, collapsed thereafter and remained in the doldrums. It has had its moment post-COVID, but still, relative to large caps, on an index basis, it hadn't done much. So the lake was again very empty, very ripe for filling up rapidly, because this lake, the kiddies pool, can fill up very quickly. And we are seeing that fill up very, very quickly. But this pool, because it is a kiddies pool, can expand a bit. Large caps, because of their sizes in terms of their overall, let's say, a big bank or a big FMCG company, have limited room to expand. They will grow for sure, but obviously at a far lower rate, while the kiddies pool end of the market can expand a lot more, and which is why I'm extremely excited about the kiddies pool.
Shankar, sorry, I couldn't resist. Rima has a question, but Rima, just tossing to you. Kiddies pool, you need those vests and those, what do you call, Nigel? Kiddies pool, I mean, is he the...
I call it the kiddies pool.
No, I mean the, what do you call the, not life jackets, but those rings, right? I mean, those tubes, plastic tubes too.
The floats.
So that you're safe, floats. Thank you.
Always, 100%. So in the adult pool, you have the blondes in the bikini. Sorry to use that, and I don't want to sound, in any way offensive to the ladies, but I mean, that's that, or the hunks in their briefs. While the kiddies pool requires you to have mandatorily, those floats around your arms and chest and whatever. So yes, it's a dangerous pool. You can not drown, but at least get a bit of water in your lungs. So yeah, it's always, you need to be actually probably a bit more careful in the kiddies pool. That's a good point, Prashant.
Shankar, do stay on because Prashant has now moved over to the big wall and he's going to tell us about the 5 key drivers which have led us to our all-time high levels.
Well, thanks very much for that, guys. So just recapping, right? I mean, there's nothing new that we can say, but these are some of the drivers over the last couple of months which I think are important just to recount, nothing more than that. So let's just start top down. Growth re-accelerated, right? I mean, we're looking at the fourth quarter GDP numbers which came through. And that number came in and surprised everybody, 6.1%. And what that has done is economists have marked up their growth estimates for FY24 as well. So that is point number one. So there is growth. Inflation is number 2. And that's been steadily coming off. I mean, the pace of disinflation actually has surprised many people. Core inflation has also come off very sharply. Although no one is expecting rate cuts, it's been maybe pushed out a little bit, but perhaps later this end of the year, early next year, that is an expectation as well. Let's come to corporate earnings growth. Here, maybe there is perhaps more work which needs to be done, but fourth quarter numbers were most definitely better than third quarter. Third quarter numbers saw lots of downgrades to full year estimates. Fourth quarter was a little better as compared to the third quarter. By the way, I looked at Bloomberg estimates. MSCI India earnings for FY24 are expected to grow almost 18%. It's not bad. I mean, of course, will this see downgrades like what we've seen for many years, or will this be met is the question, but optimism still there on corporate earnings growth. Some of the structural factors, right? We talk about infrastructure to no end in terms of the build-out that we are seeing, the strong sort of allocation in so many sectors from the government, and I think that's a very strong top-down theme which has got so many multiplier effects. Manufacturing businesses, I think, is another strong area. There is, of course, China Plus One, which is a strong supportive theme as well. And this is an interesting bit. We talk about India versus China, Indian market, Chinese market. Of course, I mean, the market there is much larger, but it's about incremental progress, right? So consider this. India is expected to add 100 million people to its working age labor force between 2020 and 2030. China, in that same period, 10-year period, is expected to lose 25 million workers. Of course, this points to demographics. We've got to, of course, create jobs for these people as well. But that's a slightly kind of longer-term, more structural drivers. External sector has also turned around. So it's been pretty dramatic. We had a current account deficit just late last year. It's now swung to a surplus, a small surplus. We got the BOP data just yesterday, which also points to pretty stable trends, at least for FY23, maybe a little bit of weakening into the early part of FY24, but nothing to be worried about. Strong FII inflows have also, of course, helped quite a bit. So these are, just 5 things, more structural kind of drivers which have helped us along the way. I just want to leave you with 3 risks to be mindful of, and something which Shankar was also referring to. One, of course, is global growth, which I think one needs to be mindful of. It shows no signs of weakening. People have been waiting for a US recession for a year and a half. But guess what? Latest data shows that the US consumer is in good, in a good state. But if this were to come to pass, It could hurt specific sectors, IT services, etc. More specifically, valuations. Historically, India's premium to emerging markets has been about 50%. We're about 70%. Depends on how you measure this. And of course, third is monsoon rains, which I think one needs to be mindful of as well. So these are some risks at the margin. I mean, something to be watchful about. But generally, actually, I would characterize this to say, Shankar, that while on the index, maybe some euphoria in smaller segments of the market, mid-caps, small caps, etc., on the frontline indices, there is very little euphoria. The euphoria, if anything, is around prospects for India and India's time in the sun and things like that, which isn't exactly all that bad, as long as it is not spilling over in a very large madcap rally in stocks, which we've not seen so far. Shankar.
Yes, so the factors you point out are absolutely spot on, Prashant. And the fact is that India finds itself in a near, touchwood, near perfect position on a global macro basis. And China's woes have really come at the right time for India when America was looking for alternates, or let's say the world was looking for alternates to China. And if you go back in time, 2002 or 3 was when Goldman printed the BRIC report, which I thought was a bunch of nonsense at that point, and I still believe so because it was an Excel spreadsheet going out till 2070 or 50 or something. Now I believe they've extended to 2075. But the fact is that out of those 4 initial nations, China has done very well in that interim period for sure, no doubt about it. But then it has already reached a middle income status. The growth numbers cannot remain what they were. Stimulus cannot endlessly keep propelling it. About Brazil and Russia, the less said, the better. So that really leaves out of 4 reasonably good-sized countries, markets, populations, just India. So India is really offering itself up as a near-perfect investment destination. And I, for the life of me, cannot understand why FII sold off so much as they did in the last couple of years. I mean, it is beyond any rational thinking. But be that as it may, it actually made a good case for domestic investors to step in. So we have already created a fantastic pool of domestic investors. And now with FPIs also turning positive, I mean, I don't see any real risk. The risks you mentioned, Prashant, are more that we need to have some risk. You cannot have a table with only goods and none of the bads. So it's more a formality you did. And the fact is I don't really see much of a risk out there for India.
All right, Shankar, final question before we let you go. What have you been buying lately? BLS is the last reported one. Dronacharya is something that you've spoken about in the past as well. Everyone's got their life jackets on, the floats on from the kiddies pool as well. But a couple of stocks that we could discuss.
I'm putting on a snorkel right now because I have to really do a bit of a dive here. But you will hear about it soon, I guess in the next 2 weeks' time.
Okay. Can you tell us some themes? Because you've been very good at catching the up cycles, the down cycles, the turns in the market. I remember you spoke about IT. You got in at the right time. Metals as well, the commodity space. You had caught the up cycle. Right now, can you tell us the themes over the next 6 months? Which themes will do well?
I've said this, I think, on your shows as well, Rima, but I'll repeat it. I believe, and one of the reasons why I like small caps so much, and particularly domestic-focused small caps, is that the addressable market for each of these companies is now equal to the GDP of large countries. I mean, when I entered markets 35 years back, India's GDP was probably about $200 billion or thereabouts. Today, we add $200 billion to GDP every year. That's the size and scale of what this market is about. I mean, I think 2 states, Gujarat and Maharashtra, must be well over $1 trillion in GDP. Each part of India, I mean, if you divide it into 4 or 5 zones, must be at least $500 to $1 trillion. I mean, that's a huge size by any standards, and which is why you are seeing small companies deliver good numbers, because even those and those small companies obviously are not pan-India, they're focusing on their neck of woods. But even those neck of woods are offering them very large size revenue and profit potential. For example, I met a company a few weeks back. It's in the jewelry space, like a Titan for the lower end of the market, servicing only one part of India, not a particularly rich part of India, I must say. It this year has made a profit of 120 crores. a profit of 120 crores while servicing all of, I think, 3 states. I mean, that's astonishing numbers by any standards. A company that I invested in called Annapurna Swadesh, which was a small IPO a year back, I think it's up like 7 times from the IPO price. This year, we expect them to, this quarter, we expect them to do numbers which will be equal to the entire last year's numbers. So the themes are small caps focusing on individual areas of India, not just pan-India plays.
Shankar, it's always a pleasure. Thank you very much for joining us as we make new highs on the index.
Guys.
And thank you very much for being here on CNBC-TV18 as well. Well, 50 points, by the way, on the Nifty. 18,871 is where we are at. And, it's looking pretty solid. Session so far. By the way, we've not addressed mid-caps, small caps, etc. Maybe take a minute exactly to do that in terms of what's happening in the broader space. So I think we did mention Delta. Delta was a mover yesterday as well. If you can just quickly put these intradays up. Delta is up about 4% or so. Suzlon is coming up with, it's almost, by the way, $15. Suzlon. It's up 5%. These are coming up on the top of the list. Adani, Nigel mentioned, with I think there have been large blocks which have happened. 3.5% on Adani. Big gains, big volumes. Aavas Financiers, 4% gain. I think there's a CLSA note, if I'm not mistaken. Aavas is up 4%. BSC, we were discussing this entire move by NSE, and maybe it does benefit BSC for now, 2.5% there. JBM Auto is up about 4%. You got stocks at about, 1128, 1129. Surya Roshni is another one which is up 4%. Surya Roshni has had a decent run last couple of days. Titagarh Wagons is coming up with a 2% gain. CMS Info, let's have that up 374. Stocks up about 5%. Look at the move in Landmark. We had that one day after that block where the stock was down a little bit. And yesterday 5%, today 5%. So net, from the pre-block level, it's up 5%. Accounting for the cut as well, but it's doing well. Another 36, 37 rupees on that one. 762 on Landmark. And I could go down the list, but then volumes will start to taper off a little bit. But there's a fair bit going on. Look at Shalby Hospitals. Stocks up 7%, 178, 179 on that one. We had the management of RK Forging with us earlier. That stock is up about 2% as well. So, the broader market is what we needs to be highlighted because that's where bulk of the action is. 60 points on the Nifty for now. We'll take a break here. Abhizar Divanji of EY India and Srinivasan Varadarajan of Union Bank of India will join in to discuss the impact of the HDFC Bank merger on the overall banking landscape and, of course, what it means for the entity itself. A little later after that, we'll connect with Subhrajit Roy of Bank of America to discuss the recent spate of block deals. Stay tuned. Those conversations coming up next. Okay, welcome back. So we've got, 65 points in the Nifty. Things are looking good. The biggest transaction in India's corporate history could become a reality in 2 days. HDFC Chairman Deepak Parekh says the merger of HDFC and HDFC Bank may become effective from the 1st of July, and he expects the HDFC stock to delist on the 13th of July. HDFC also has bought 1.5 crore HDFC Life shares as it looks to become a majority shareholder in the arm ahead of the merger. There is some more to go there in terms of purchases in HDFC Life. Abhizar Divanji is with us. He's head of financial services at EY India, and Srinivasan Varadarajan is non-executive chairman at Union Bank of India. We'll talk about, of course, implications for the entity itself and implications for the broader ecosystem as well. Gentlemen, good to have both of you here. Thanks very much. Prashant, this side. Abhizar, if I can start with you, any thoughts on the effective date itself? Do you reckon the effective date is going to be the 1st of July? Are there any chances that gets pushed out a little bit as teams prepare for the final integration, the merger? What's your sense?
I think day one of the merger will be the 1st of July. And I think that's been thought through, and I think it's been worked upon for a while now. So day one of the merger is actually the day on which the merger accounting will start and the entities will start reporting themselves as one entity. Integration is what follows after that over a day 100 period, where they will try and merge the entities into one operation. But effectively, the control, the management will start effective July 1, and I don't see any hitches coming to that.
Mr. Varadarajan, we're going to see a behemoth, I think the 10th largest bank in the world once these two are merged. What does it mean for the competitive landscape for the Indian banking space?
I think it looks positive as far as the Indian banking system is concerned. If you look at any of the large economies around the world, the top 4 or 5 banks constitute almost 50% of the banking system. And in India, we are heading that way. If you look at what's happening in the private banking landscape as well as in the PSU banking landscape, I think consolidation has been something which has been happening over the last almost decade. And this is another big step forward in creating a large private sector bank, which ranks very high in the global banking rankings. And clearly, this is making India a lot more. The Indian banking system a lot more stable, robust, and very attractive destination for people to look at and invest in.
All right, sir, but won't it spell more competition as well? Because you have this large bank that's coming on stream. I mean, has a advances book of 22 lakh odd and could grow at a sizable pace as well from here on. Don't you think it'll be more competition for the others?
Ultimately, the bigger banks continue to become stronger, healthier, and grow faster. And the smaller banks will have to sort of do a lot more lifting to sort of compete. And that's going to be the name of the game here too. HDFC Bank was clearly going to up the pace as far as the other banks are concerned. And the large banks will surely be able to sort of match that. The smaller banks will have to do a lot more lifting. And I think that's going to be the way forward. And the smaller banks will have to pay more, will have to do a lot more running, will have to be much more nimble, and have to build niches and business models which are not very which is overlapping with the larger banks, and they got to find their own niches, whether it's regional, whether it is products. So I think you'll have to position yourself differently. The larger banks, the money center banks, as we call it in the US, I think these are the banks. The HDFC Bank will be one such bank, and you have the other banks, whether it's ICICI Bank or Axis Bank. And so these banks will continue to dominate the Indian landscape. The smaller banks will have to find their niches there.
Mr. Varadarajan, just talk to us operationally. I mean, how this how this would work. I mean, as Abizar also pointed out, that effective date is 1st of July, but after that, I mean, the integration will continue. It will take time because these are such huge entities. But broadly, the bank would have mapped out customers, etc., at HDFC yeah, go on.
All that would have happened over the intervening period. I think over the last year, I think surely in terms of customer mapping, in terms of who's going to do what, how is it going to work, all that would have been done. I think that integration process would have commenced right from the day they announced the merger, and clearly that process would have started. So the whole thing in terms of how it goes forward, I think it's just a continuum. I think there is going to be no sort of D date or T+0 in which the integration is going to start. The integration would have started a long time back, and only from an accounting point of view, the balance sheets and everything would sort of merge as far as Abizar is saying as of July 1. But the integration would have started a long time back, and that will be a continuous process, and that will go forward in the coming year.
Abizar, is there any one or two areas which I think we need to sort of watch as we get numbers on a consolidated basis going forward? Any particular segment, anything which kind of will tell us about how the merger itself is going? Any areas of risks, etc.? Any possible areas of friction? Or you think it's all going to be pretty smooth?
No merger is ever smooth. And I think even though it's a parent subsidiary entity, I think the mindset of an NBFC, the way an NBFC has been run and the way a bank has been run is pretty different. And ideally now, the bigger challenges that are going to be faced is that there is a 90,000 crore priority sector lending implication that is going to come on the bank over the next some time. Now, how that is deployed and what impact it has on the NIM is a very big issue. So are they going to be doing PSL certificates? You see what will happen to the PSL market. If 90,000 crores of demand comes into the market at one stage, I think that the demand will simply rise significantly, and that will impact the cost of funds. On the other hand, if HDFC decides to set up a vertical to say that let me go and deploy on an MSME sector, How are they going to do 90,000 odd crores worth of deployment over a period of time? It takes real effort. You know, you end up creating a bubble in that kind of a private sector market. That's one. The second issue is in the SLR CRR issues and how they will be generating cash. I remember ICICI's time, they had to do high cost borrowings, and that high cost borrowings impacted the NIM over the next 5 years. So I think structural balance sheet issues are one thing that the market really needs to worry about, and how these two big things will get tackled. HDFC has done a few right things. So they were not on the bank borrowing side, and over, as was said earlier, over a period of this announcement to commencement or to completion of merger time, they've actually refinanced a lot of the bank liabilities with bond liabilities. They came out with the largest bond issue sometime last year. So that has helped structurally take care of the regulatory requirements of the balance sheet. But I think going forward, how they deal with the PSL issue and how they deal with the SLR financing is, I think, the two main things that will impact the market. The other thing, of course, is you will see a lot more cross-sell happen. HDFC is a behemoth, and trying to convert a lot of their asset customers into liability customers and making sure that the liability franchise is captured well across customers is going to be a challenge that HDFC employees will need to work towards. And the whole focus that it will have to remain, see, the private sector today is very much restricted to low-cost housing. How do you meet the other requirements of RBI, which is MSME lending, agri lending? How do you go about it? And the other big thing, the big responsibility, as Mr. Narayan also said, that comes with a large bank is, are you going to be lending to Indian infrastructure, which is a prime need of today? And the larger the bank you are, the better is your ability to lend. HDFC as a group has never lent to infrastructure except housing. How will they lend to, lead India's growth? These are the areas one would look at.
Interesting discussion there. And gentlemen, thank you very much for joining in, Abizar as well as Mr. Varadarajan. We'll continue chatting with you all through the course of the next few months as the integration between HDFC Limited and HDFC Bank takes place. Let's move on to another important topic. We've seen block deals worth $2.4 billion in this month itself. You heard it right, $2.4 billion. Yesterday was Sapphire, last week we had Landmark, and of course, so many more. What's behind this heightened deal buzz? To discuss this and more, we're joined by Subhrajit Roy, the India head of Global Capital Markets at Bank of America. Subhrajit, thank you very much for joining in. This is Rima here. So, when promoters, large marquee investors come to you and they say that we want to exit or sell part of our holding in a substantial amount, 3%, 4%, what's the rationale behind this? Are they uncomfortable with the levels that they are seeing in the markets and they believe there is a downside? Are they doing it to raise money? Can you explain what's going on in the minds of the promoters and investors as they are rapidly paring down their holding or taking advantage of the heightened levels right now?
Sure. Good morning. I think a great day to have this call with markets reaching all-time highs. I think if you break it up into sellers being sponsors versus promoters, sponsors, for them, this is a regular monetization strategy they will have, and they would tend to have their own horizons and thresholds when they look to exit. And what we are seeing happening over the last month or two, frankly, while all of them come together in a very short frame of time, the fact remains is even the earlier part of the year, we saw about $2 billion of block trades happening in the first few months, and we are probably seeing another $3 billion of block trades happening in the last couple of months. I think what is important to note, it is a more thought-through strategy. It's not linked to a specific point in time. A lot of the trades you're seeing happening over the last couple of months have been, frankly, in the works or in discussions for the past few months, for past 6 months, in fact. And many of those sellers who have come to market now, they have been trades in these stocks earlier as well. So it's not something which is necessarily triggered by the current market flow, but of course in a market like this, naturally, when there is so much inflow both from the FIs and DIs, it does help to kind of get trades together. On the promoter side, and again, you're not seeing too many of them, but many of those discussions probably preceded this market rally that we're seeing now, and this so happens that it came together all in a space of time, especially when the flows were looking placed to kind of deploy themselves. So I think it is more of a matter of time when everything kind of came together. But a lot of these discussions were kind of ongoing, and a lot of these trades, frankly, were a follow-through of previous trades as well. in many of these stocks.
Well, hi, good morning, Subhajit, and thanks so much for speaking to us here on CNBC-TV18. One way of looking at it would be there's plenty of supply. The other way would be there's plenty of depth in the Indian markets. The kind of flows, the selling that we've had, and it's being absorbed on a day-to-day basis. So that's pretty good as well. But let's focus on the IPO market. That as well has come back to life. We've seen a couple of small IPOs that have come about. But do you see that IPO market as well getting revived? Should we be bracing ourselves with 500 million, a $1 billion IPO in the coming few months, given that markets are still looking quite strong? Run us through the pipeline.
Sure. So typically, what you've seen is whenever you see such large flow of secondary market transactions or even primary follow-on offerings, they're typically precursor to the start of the IPO cycle. We have seen of late, some issuers looking to catch the pre-election window, if you will, which is kind of, let's say, a Q1 of next calendar. Because as you know, people will take a pause through Q2 of next calendar, and we're kind of looking at a pre and a post-election season. Clearly, there have been few discussions where people are looking to prepone or look to go to market or being unable to go to market around the Q1 of next calendar, which kind of needs them to start working pretty much now or in the next month or so. So as the market strengthens, we would expect some of the issuers who have already filed probably looking to tap the markets again. And some of the issuers are probably sitting on the fence looking to start the work so that they can give it a shot to try and hit the market before elections. But having said that, a lot of large IPOs will probably still end up being a post-election event. But the volume of IPOs we do expect to increase between the last quarter of this calendar and the first part of next calendar.
So, Bridget, hi, morning, Prashant here. Just to go back to the blocks, which are happening. So broadly, roughly, it's difficult to be very precise, but how much of this, the sales which are happening because of, end of the fund life and money needs to be returned to LPs, and how much is it opportunistic in nature?
It is interesting, right? If you look at most of the larger trades that have happened, frankly, they have been the second or the third or the nth trade in the name. So this has not necessarily come together purely because the markets have turned or it happens to coincide with a certain threshold in the fund life. What has though happened is, given the fact that the flows have become far more broad-based, right? It is not just domestics and not some select FIs. I think we have seen a significant inflow from global funds, which were pretty absent and sporadic a couple of months back. Once you have those flows coming together, the ability to transact becomes much higher, right? Because they are looking for deployment opportunities and the sellers are out there. They have done trades. So I have not seen any of these to be really triggered by an end of fund life situation. Many of them have been pre-IPO blocks coming to market, have been coming to market. Some of them have already seen multiple sales. And I think you're seeing culmination of those happening when the flows are there to absorb them.
So sales, because there is depth in that sense. There is people on the other side. In a much larger number, so ability to transact. Got it. Now, just one more thing. These when you're seeing these sales, and I'm sure you're talking to people who are the sellers. What are they planning to do with the net proceeds? Are they putting it back? Are they looking at, because some of them are global investors, right? Lots of them. Are they looking at other markets? What's the plan broadly? If you could give us some color.
It is interesting. In fact. Given the amount of flows that we see, and we probably had a 35-40% share of the block trades the last couple of months. I think what is interesting is a lot of the sellers whom we keep speaking to, many of them are even waiting out, acknowledging the markets are great to transact, but probably they would also want to find investable opportunities in India before looking to monetize and raise those proceeds. So we are probably seeing the guys who are monetizing, but there are probably equal number of guys who are kind of waiting on the sidelines, either because they feel that there is far more strength in those underlying stocks, or they would rather find opportunities to deploy before they look to monetize. But a bulk of it are global funds where it is a regular process of churning and monetizing rather than any targeted opportunity. Some of that flows will of course find its place in India, and I think we have already been seeing a pretty strong spate of private equity activity already happening as we speak, and that actually is kind of fungible, right? And also, given the overall thesis around China still evolving, India continues to be at the forefront of attracting these flows.
Okay. All right. So, Bridget, thank you very much for joining us Appreciate you being here on CNBC TV18. Good chat, and hope we can speak with you soon again on a more regular basis as we get a color of what's happening in the capital market side. We'll take a quick commercial break here. Mitesh will be with us for some technical trading ideas. Stay tuned. That conversation comes up next.
Welcome back. 18,908 is the new all-time high on the Nifty. After hitting it in the first few moments of markets opening, we sold off a bit, but not too much. Still holding at 18,880 on the Nifty, a gain of close to about 0.3%. Where are we headed from here? What are the trades? Mitesh Thakkar joins in now for some technical trading ideas. Mitesh?
So, morning again. We talked about the fact that the markets might see some momentum and continued journey, of course. I have, in fact, two buy calls right now. The first one is Bajaj Finance. I think that's a stock, which gave a pullback in the last few days and now is again picking up steam. So, recommend to buy here with a stop at about 70.40 and a target of 72.50 on the upside can be possibly looked at. And the other one is Landmark. I think the stock has been clearly in news and showing good momentum. So here I would recommend buying with a stop at 734 for targets of 785.
Another day where landmark is higher. Even yesterday closed with a gain of about 4%. Mitesh, thank you very much for joining in. Get into a break. On the other side, our special segment, it's the economy. Lata will get chatting with Deepak Shenoy of Capital Mine and Digant Haria of Green Edge Wealth Services to talk about the growth trajectory in NBFCs and the banks.